ever since the early 90s, so the fall of the Soviet Union and then the opening of China starting in the 80s and really ramping up in the decades that followed, we connected Western capital with Eastern resources and labor. And we had this kind of 30-year period of globalization. And that was really big boost for efficiency. Everybody kind of focusing on what they do best or what they're deciding to do best. But it came at the cost of fragility, which is, if we just say, okay, China's going to make all the rare earths for the world, and that gives them the power to say, well, we're not going to give you rare earths because we don't like you. If the US does all of XYZ, we run the global reserve currency, we can just unilaterally sanction any country we want for basically any reason and freeze reserves and things like that. If there's only, 3 countries in the world that have decent semiconductor foundries, then every other country is reliant on the good graces of those 3 countries in order to be competitive in the digital age. And so that works as long as everybody's friends. Historically speaking, when you have rival powers, that's when things get riskier. So in World War I, you had, the rising power of Germany right near the kind of the fading empire of Britain. Germany had the big industrial base. For a variety of reasons, that didn't go well. Obviously, then during the U.S. Cold War, U.S. and Soviet Union, tensions there. And now there's a natural tension between the U.S. and China as the 2 biggest economies in the world with rather different political systems, rather different priorities. It behooves everyone to work together, but I do think that when really big imbalances build, it starts to cause problems. And I mentioned before, for example, the way the trade deficit and dollar system work, if we say, okay, China's going to make all this stuff, that's great if you live in New York. Like if you work in finance, you can kind of look at a map of the world and be like, okay, China's going to make all this stuff and Europe's going to make the wine and we're going to go there every summer. Colombia's going to make all the coffee and, it's going to be great. But if you're in Michigan and you live in the Rust Belt or Ohio or certain parts of Pennsylvania and, your economy's been stagnating for decades and you've got higher rates of like drug addiction, kind of the deaths of despair type of things that we're seeing in kind of the U.S. heartland, unfortunately, they see it rather differently. They're saying, well, you're hollowing us out, setting our industrial base to China, and then they're reinvesting their stuff into New York assets, like financial assets. So if you're Michigan, you're on the wrong side of all of this. And so there's winners and losers of every system. And the current kind of downsides of this, of everyone working together, is one is fragility. It only takes a few entities to decide not to work together. It could be China, it could be the US in this case. And so, okay, we're kind of breaking up that fragile system. And then the reasons for breaking that up is because there are imbalances in it. Similar things with like, if the US wants to fight a war today, our ability to rebuild missiles or rebuild ships is super slow now compared to what it was historically compared to adversaries. I mean, China's shipbuilding capacity is like dwarfs ours to a comical degree, and like their drone making capacity and things like that. And so that's what keeps certain entities in DC up at night, for example. There's certain pockets that are starting to see the actual downsides of this arrangement. I see a chance, but I would describe it as longer term pain. I think this was an imbalance decades in the making. And this is not one of those things that just like 6 months of pain changes it. It's like turning a container ship. It's a really long, slow process. And unfortunately, the way that trade deficits normally close is not pleasant, which is to say, normally demand collapses either because of policy changes or currency crises or something. The economy goes through some degree of disinflation, stagflation, kind of slow growth. Then their exports become more competitive because they're weaker now. And then they're able to kind of rebuild their tourism, depending on what kind of country it is, or their exports. Basically, it becomes more attractive to use their goods and services because they're cheaper. And then they kind of recover from there as long as they don't, turn communist or, kind of go off the rails, as long as they maintain kind of sense to them. And I think the US has to go through a pretty painful process. There's no great solutions because if you keep the current solution, we're going to continue to hollow out industrial base. You're going to continue to have rising political populism from the places whose industrial base is being chipped away at, and that's just going to keep building. On the other hand, if you do start to address it as we are now, say we even start to address it more gradually and less volatile way, but we do start to address it, that's probably not great for people's 401ks because that whole mechanism of running these giant trade deficits and then the worst world shoves them back into Apple stock and Nvidia stock and all that, that's kind of over or at least slowed down around the margins. And so the stocks going up every single year almost is, slower or non-existent for a period of time. And then you could have stagflation for a period of time. It's more expensive to make goods here. In addition to our overvalued currency, we now have the highest healthcare costs in the world on a per capita basis. So for every American worker you hire, that's a much more expensive proposition than hiring, a Chinese worker or a Vietnamese worker or even a Japanese worker. Japan, despite the fact that they're 10 years older, has way lower healthcare costs than us and live longer. And so even other developed countries are often cheaper to hire similar levels of skilled and educated workforce. It's a long-term process to go through because it's a long-term process in the making. So I don't think this particular move was deliberate. According to Myron's paper, this was supposed to be the stronger dollar period. And unless there were behind the scenes ones, there haven't seemed to be any currency accords to speak of. In order to actually weaken the dollar meaningfully to impact the trade deficit, it would have to be on a sustained basis and way lower than now. The problem with that is that comes with the risk for higher inflation and the risk for a bond market sell-off. And that's why, for example, Myron's paper discusses ways to mitigate those. One is to make sure there's as little supply disruptions as possible. So produce as much oil as possible, deregulate businesses as much as possible to make it easy to form and operate a business, keep the costs low, so that even if you have a weaker dollar, you don't necessarily get the oil price spike or other things that are associated with a weaker dollar. And then two, and this requires a stronger negotiating position, is to basically convince a lot of other countries to term out their US debt, despite the fact that the dollar is inflating away. Basically sell them on the idea that that's their cost for being under the US military security umbrella and to have good trade deals with us. That's what I think is going to be very hard to do. And the unilateral mechanisms for dollar devaluation, they mainly come down to printing dollars and buying stuff. The US, we actually have among the lowest reserves relative to GDP in the world, because with the axiom of the system, we operate under the view that we don't really need reserves. But one of the ways to weaken the dollar is to, print dollars and buy reserves. That could be euro assets, that could be yen assets, that could be gold, that could be Bitcoin, whatever's kind of big enough to absorb potentially trillions of dollars of purchases. But again, that comes with downsides. That comes with, likely weakening the dollar, risking higher inflation, risking higher bond yields, and causing issues. That's why their ideal approach is a multilateral currency accord. And then there's also the optical approach. Nothing associated with Donald Trump as a brand would they want to use the word weak, that we want a weaker dollar. That's not how they're ever going to phrase it. They're going to phrase it as either other currencies not being undervalued, fairly valuing their currencies, rebalancing the currencies. There's an optics way of phrasing it, which is basically the same thing as a weaker dollar. So the initial reaction of the bond market was poor, which is that when we had rather disorderly sell-offs in the stock market, normally you see a flight to safety in bonds and the dollar, but we saw bonds sell-off and we saw dollar sell-off. And normally you see that in emerging markets. That's a capital outflow. That's basically foreign investors looking at an emerging market and saying, I want to pull my money out. So I'm not switching from stocks to bonds. I'm literally just pulling money out of that economy around the margins. We saw, a bit of that in the US. It's obviously different than an emerging market. It doesn't hit us as hard. It's relatively small numbers compared to the grand scheme of things. But basically, when you have stocks down, bonds down, yields up, dollar down, and gold up, that is an anti-US exceptionalism trade. It goes against really what was supposed to be happening for them at the time. There are a number of us analysts that were not surprised by it because we've been kind of highlighting this issue for a while. Now, as the dust settled, bond yields drifted back down, and now you have a lot of US financial markets pricing in higher probabilities of recession. So not necessarily imminent recession. There's still a lot of uncertainty. There's noise in the data due to import front running. There's some signals coming in strong, other ones coming in weak. But overall, multiple market participants are pricing in, for example, lower oil prices because of expected lower global demand, slower global economy, as well as disinflation in general for a period of time as the economy slows down. So bond yields got a little bit of a bid, but not as much as you'd expect given the turmoil. And so I think that's another thing that they have issues with, which is, a few months ago, a lot of people were optimistic about Doge's ability to cut the deficits. So far, spending is higher this year than it was this time last year. They're not really able to tackle the really big spending areas. So Medicare, Social Security, military, they're going to boost, interest expense, and veterans benefits. I mean, that's 85% of the budget. So the other 15%, they can talk about it a lot. They can go trim this agency and get optical wins here and there. But if you're going to go after $1 trillion deficits, you got to touch those big things. And in the 2024 GOP platform, they specifically promised they won't cut Social Security, Medicare, or raise the retirement age. And of course, the Democrats agree on that. That used to be the Democrat position of the Republican Party, which was the 2010s. There's really no good way to tackle that. Now, I think the current approach is to hope the tariff revenue comes in and reduces the deficit a little bit, which I suspect it will if they keep some degree of tariffs on. I mean, if you have $4 trillion in imports and you tariff it at 10%, you can get $400 billion. And the problem is it's not perfectly linear. So you could, for example, have a slowdown in the economy and less imports, and therefore you could undershoot your tax revenue estimates and cause other issues there. So that remains to be seen. But basically, deficits are still big, and I think that there's going to be a rocky road ahead in terms of both the fiscal deficit, the trade deficit, multiple fronts. Very difficult problem to address. I certainly wouldn't want to be the one trying to address it. they're inherently somewhat backward looking. It's funny because it used to be that the market was pricing in a June rate cut. Now the market's more looking like September, potentially the first rate cut. These things can change. That's partially because economic data came in a little bit hotter than expected. And yet, for example, if you look at oil prices, I mean, that's pretty much predicting disinflation. Break evens are very low, although historically they've not been good at forecasting inflation. Like they didn't see any of the post-COVID, pandemic inflation, stimulus inflation. The CPI prints down to got a two handle on it. So I think that, probably the right move for them is to mildly trim interest rates by the midpoint this year. But I don't think it makes that much of a difference. I've been kind of highlighting for a while that we're in a fiscal driven economy. So fiscal decisions are a way bigger deal than central bank decisions, especially in terms of interest rates. One of the ways to try to support the administration would be to cut interest rates, but that would kind of threaten central bank independence. So my kind of base case is that until the end of Powell's term, he's probably going to lean somewhat hawkish until we get major economic deterioration, which we don't know if we're going to get yet. When they do replace him, whoever they replace him with will probably be more willing to work with the administration, help, reduce the short end interest rates, maintain a steeper yield curve, which allows banks to potentially absorb more of the treasury issuance, things like that. So I think there's kind of the Powell Fed, which I think still probably going to run status quo for a while, eventually gradually start cutting. It's hard to say when because it'll depend on what economic prints come in, but then probably, potentially a step change once we have a new chairperson. Well, it's risky right now because retail's aggressively buying the dips while professional investors are spooked, which is not usually the most optimistic sign for what's going to happen. I generally think caution's warranted here. The way I've been approaching it is, one, have more diversification than the NASDAQ or the S&P, which is to say several of the Mag 7 stocks I don't love here. For example, Apple, I don't love the current valuation relative to the growth prospects, whereas there are others that I think are good. I mean, I have no major issue with Alphabet at the moment, for example. I take them on an individual basis, but in general, I lighten up the Mag 7 exposure, have more diversified exposure, including to international markets, which have surprisingly held up pretty well this year so far. I replace a little bit of the equity exposure with Bitcoin. I replace the long duration bond exposure with gold. To the extent that I'm in treasuries, it's generally shorter duration treasuries or mid-length tips. And I've been selling cash secured puts for part of the portfolio, which is to say there are stocks that I identify that I would like to own fundamentally and at a price that I think would be fair. And I set aside cash and I sell cash secured puts to earn income in this fairly high volatility environment. So if the stock price doesn't come down to my strike price at that time, I just pocket the money and try again. If the stock does have a big sell-off, then I'm happy to buy it at the price that I kind of pre-specify. So it's kind of like getting paid to do a limit order in a sense that I'm kind of obligated to unless I want to buy it back. So I think there are ways to gear your portfolio around a choppy market. But I agree, it's a difficult environment, no great answers. And that's partially because the economy itself is in question. I mean, tariffs on multiple things, unclear effects from that, big geopolitical negotiations. I would just generally have diversification and gear yourself toward being able to make money in a choppy sideways market.